I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Lindsey Bell with theStreet, and together we bring you the morning call. This morning we see markets are a bit mixed in England and Europe. Those markets are up, but overseas in Asia, those markets are down. Japan has moved down 6% in the last 2 days, Scott. This has been a leading indicator for our market over here, so what are you seeing?
Well, I think on Friday, Japan was down a lot, so our markets were off a lot, and then we absorbed it. Now I think people are going to try and figure out, can we do it again? You know, the 1 day, down move, okay. 2 days, down 6%. You know what? It's starting to bring out some market skeptics. You look here at the chart of the EWJ. It's a good, visual. This was your top here. This was your exit sign here for Japan. Before that big pullback from here, nice little spot to put back some risk, which we talked about. Then it broke through this downtrend, and right around here, people are trying to figure out, is this a double top, or will it digest before, going again? And then all of a sudden, boom, so decent little decline. We also talked a little bit about bringing down some risk in this area, but anyway, with that said, I would think this 1120 area should hold if the Japanese markets want to continue to go in stride. So the question is, this market's been a bit of a leading indicator for most of 2013. Will that happen to our indices as we're stalling right in front of that 1700?
Oh, exactly. We should take a look at our chart, the SPX, to see how that compares to this chart that we just looked at.
Yes, well, we're talking about that chart. We started seeing some mixed signals last week. And then on Friday, the bears had a little bit of control to break it or not. And if you look here at the chart, they didn't. Okay, you go to the SPX, and the question is, there's like 2 different patterns coming in here. First of all, remember this outside day from May 22nd. That actually resolved this descending channel to the downside. And I remember it actually, didn't get much follow through in the beginning. Looked like we were holding in here, and then we started that 6% decline. So here we are. They remember this little bounce back above the 100-day, digest it, took back the 50-day. Nice, healthy move back to the highs. So here we are. Let's take a closer look here because you have 2 different things going on. Okay, first of all, we had this ascending channel here, which we talked about, which made some sense to take some risk off right around here. Okay, but then what we do? We held this longer-term support, creating what I see here as another little channel. So the question is, I think this is what guys are going to be basing their week up on is, do we continue to go sideways and hold above this 1670 area, or at some point, do we start to falter and break it and get some kind of corrective activity to test the lower area? So at this point, at least we have levels to navigate, but the longer we stay above this area, I think the higher the probability we take this out to get to 1700. So at this point, I think traders have 1 foot in the door, 1 foot out of the door, and they'd rather be at the beach since it's summertime.
I know, and it's a shame because this week is actually a really big week. We have a lot of data coming out, especially economic data. We've got the 2-day FOMC meeting with the statement on Wednesday, the Bank of England on Thursday, jobs number on Friday, and plus we still will get a handful of earnings. There's going to be a lot to watch.
Yeah, so it seems like there's always something that you could be worried about, and this week, last week was earnings, and I'll be honest, earnings haven't been that great. Yeah. Revenues have been a little bit lighter. The earnings, the EPS have been okay because of buybacks and because of cost cutting. So a lot of people are pointing at the fact that corporate earnings aren't robust. They're okay. So does it give credence for a move through all-time highs? But anyway, the Fed is happening this week. I think the market's pretty comfortable with the fact that they're not going to do anything to really shake things up Tuesday, Wednesday. The taper talk has been set for the September meeting, and I think people are kind of comfortable with reducing the pace of purchase from 85 billion to about 60 billion. So I think as long as there's no curveball, we're not going to see something too different. So we just need to get through this week, and we'll probably have a lot of the same type of action, which has been, tactical, very stock specific for earnings, a lot of have and have not. So things to do over the summer. That's all you could ask for, Lindsey, is things to do with low volume and not much going on out there when people are taking vacations here.
Yeah, no. So we should look at all the different sectors and see how they're reacting to what we've gotten out of earnings and just different things over the last few months from Bernanke and the Fed and everyone else. Let's start with the Russell 2000. This has been on fire. It's the small cap index now. But last week it started to show signs of weakness.
Well, you want to take a day to take notice, and that one day doesn't mean much unless it leads to further weakness. So we've been looking at the Russell to try and get some clues on whether or not we do get some corrective type activity. And all in all, you look at the chart here, you'll see yet a really nice move through historic highs that lasted for many sessions. And then finally, right here, you had that potent down move. Some actually made some cute money short when we went below 104 1/4. Okay, that gave you that quick little move. So here we are, though, going sideways. Okay, so at this particular point, we're holding the 8-day still above the 21-day, above the 50-day. So at this point, short term, yes, little faulty signals, but so far not adding too much. So I would say watch this area, watch 103.33. As long as we stay above that, bears aren't going to be able to growl too loudly. But if we do start taking this out, chances are, you want to have a little bit more risk off.
And now, how about the financials? This group, they've led this year, which has been great. Expectations going into earnings were very high. Most of the banks have met. We still have some insurance companies that will be reporting. But last week, they also saw a little bit of a pullback. Is this a buying opportunity? Will this group continue to lead in the second half of the year?
I think it's going to be a group to go to, and I still see a higher price. It's just the question is from what point.
Yeah.
And if you look here at the XLF, there was a cute trade there. Look, this was that descending trend line right here that we broke above, giving you a nice move. And then right here, there were some people that were able to make some money below 2077. Right, that was the first time out of many that you had to close below, what's it called, a prior day low. And then what did it lead to? Not really much. Okay, it's getting close to the 21-day. Things are catching up. A lot of banks are still hanging around there. So overall, short term, yes, there was a trade there, but longer term, still above all the moving averages and still looks good for new highs at some point in 2013.
The retail group held in really strong last week as well. It's been another strong group all year. Those guys won't really report earnings until mid-August, though we have heard from the likes of Dunkin' Donuts and Starbucks and some other restaurant companies that they're saying the customer is being resilient and hanging in there. So hopefully we do see good reports from these retailers in August. But what does the chart look like?
Chart looks very strong. It's been strong all year. A lot of retailers have been making new highs. Look at this chart, compared to the last two that I just showed you. This has just been going sideways, letting the 21-day catch up, holding the 8, closing near highs. So if this were to get above, 81.55, this will be one of the first sectors, to make new 2013 highs before the S&P.
Now, last week, you signaled to take a look at the home builders because you started to see a little bit of weakness in there. This is going to be a group to watch this week again because any talk around interest rates and tapering, this group definitely moves on it. This weakness, though, is it a buying opportunity or is this a group that you want to stay away from?
I think it's a group to give time. If you're in it for a long time and a macro investor, don't overtrade it. But short term, a lot of the stocks within this group have been, lagging a lot, or showing real signs of technical weakness. And, things change. Money rotates. So you don't want to be left caught holding the bag. And you look here at the XHB, you'll see, here's the high. Then you have a lower high and another lower high. And then in this inside range, it resolved to the downside. Okay, so this is well off. This is already below the 8-day, below the 21-day, below the 50. So it's showing you some relative weakness. And then you also had a gap down right here. Okay, so question is, I would say, if it can't get back above this little area quickly, 30, 30 and a quarter, this could give you some clues that we could be seeing more weakness. If it's just taking time to digest what's been an unbelievable move, because we've had an unbelievable move in this sector, and it's still, holding this trend line, it's still holding above, this trend line. There's still a lot to like here on a macro basis, but if you take a close look, you just want to make sure that things don't change. And right now, this group is getting a little weaker with the thought of higher rates.
How about the ags? This group has been weaker. Last week it led the decline. Is there more of a short move here that you could think of? Or
you know what? Every time I try and look at the ags and look at it with glass half full, it's always at the tail end of a rally because money's looking for places to go and it remains weak. If you look here at the ags, you'll see that, again, this group not even close to, look where the highs were in 2013. So it didn't make new highs in May like the rest of the market, and now you have another lower high here. This has been a laggard group, a laggard sector, and every time it looks like it's going to get a little bit better, it doesn't. This was your last little flag type pattern here that resolved to the downside. Okay, this one, there was a little bit of a trade here at the lows because the market had such a big bounce, but all you're doing is getting these like laggard type bounces. Until the real trend breaks, look for shorting opportunities here or just avoid it.
Well, we're going to take a quick commercial break, and when we come back, we'll get into the trenches with tech.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
Welcome back. Tech has been a mixed bag of earnings. Last week we got some more tech stocks reporting. Amazon was one of those. Thursday night they reported they missed estimates. Management continues to invest in that business. Margins continue to contract, but Wall Street didn't care. That stock ended Friday up 3%. It's up 25% year to date, I think.
Hey, there's always a lot of naysayers in Amazon because the PE is high and the valuation is considered enriched, but overall, technically this stock has been acting very well, and this was a stock we've highlighted so many times that should be one of the first few to make 2013 highs. And overall, you can't fight this type of stock. If you don't understand it, avoid it. But there are a lot of people losing a lot of money just trying to be shorted. Overall, you look at the chart and technically, you take the earnings out of the way and the pretty picture stands firm. Here is the first time we talked about it when it broke above 272, then when it broke above 285 pre-earnings, gave you a nice trade all the way up, and then it was hanging around, not at the high, the high end of the range, but above the 21-day. And then, what you had to do on Friday is when it opened lower, okay, and you wanted to be short, it was worth a try. Okay, I'll tell you. Definitely worth a try, but then once it went back positive or went above this 304-ish area, you had to cover. You just said, okay, it's going positive on a perceived weak report. Let me get out of the way. And then once it took out 2013 highs, it's always a spot because you never know how high it can go. Was another spot to get out of the way. So now at this particular point, if it were to stay above, just say this 308 and go sideways for a while, keep it on the radar. But ultimately, technically, there's been a lot of, just a lot of signals to be long it versus short it. So sometimes it is what it is, and I have the same type of problem sometimes with price lines. So I just stay away from stocks that I have a mental block on being able to approach it, with size and based on the news.
Yeah, that sounds like a good trading strategy. Another one that was fun to watch last week was Apple. This stock expectations were pretty low going into their earnings report on Tuesday night. The company beat expectations, did better than most had anticipated, sold more iPhones, that helps their margin. But the stock rallied. I think it was a relief rally. How do you trade this post-earnings? Does it go higher? What levels are you watching?
Well, it's hard to get very excited about Apple, but I would say it's in the game right now, and it's their ball to lose again. You look here at the chart of Apple. I'm not thinking that we're going to be seeing this anytime soon. Okay, if you sold this stock when it broke 650, which was a major level, and that was like the 50-day then, or you sold the stock when it broke this trend line, or even when it broke this major support, you have the luxury of approaching it as a trader. And I think I went from an Apple bull to an Apple trader as, there was lack of commitment, throughout most of this move. So you go where we are now, you take a close look. Okay, a few things I talked about going into earnings that needed to change. Can we get a gap up? That happened right there. So let's look here. Gap up after earnings. Can we hold the gap for a few sessions? Yes, that's what we did now, going on 3 sessions. It opened lower and went right to the highs of the day on Friday. So now the question is, can it get above this mini flag area and then break above this downtrend and make a move through the fall up to 470, up to maybe even 500. Right now, you could be long this versus the 430, 434. That would be my tactical long, and then you could probably add if we get a close above 444.59. So that's how I would tactically approach Apple now.
Yeah, that'll be one to watch because they'll have some catalysts coming in the fall. LinkedIn, though, they report earnings this Thursday. That stock's at an all-time high. It's been trading up steeply into this report. It's going to have to be a good number, Scott, for the stock to continue going higher right after the report. So how are you trading it going into Thursday?
Well, at this point, I feel like as a trader, it's hard to be long it going into the number because it gave you the trade prior to the number, which is helpful because as traders, we don't like to take stocks into the earnings. We either trade them after or we use options, but sometimes options, the premiums are so high, are so high. So even if you're right, you could be wrong. You look here at the chart of LinkedIn. It's good to have you back, Lindsey, because I feel like a year ago when we were talking about LinkedIn, it was building this cup and handle pattern where we said there were like 3 IPOs or 3 new issues that we talked about to have in the drawer versus just trading. That was LinkedIn, Coors, and Starbucks. Well, here's when it triggered. Okay, and then going into the last report, wasn't enough, and it caused a little bit of a sell-off. So if you chased it here, you probably weren't able to accumulate it there. And now look where it is going into this report. So as a trader, I would not be taking it long into the report. If you want to do some kind of option play, okay. But overall, it's been a really nice vehicle on every different time frame, technically, and long-term, short-term, whatever it is you want to do. And it closed on highs. Earnings aren't until Thursday. So today, if it were to trade above Friday's high of 208.88, maybe you get another Q trade here. But overall, come Thursday, we'll talk about more of a strategy. But the real money has been made here, throwing this in the drawer and saying, you know what? New company, great IPO, small float, short interest, potential for growth, and not trying to be too cute here.
Yeah, it should be a good one. Also, one company that reported disappointing results early last week was Netflix. Their subscribers, they were much weaker. This company is spending all sorts of money to get original content. Like they put Arrested Development up. I don't know if you watched that, but it's just
not that old.
People want them to bring in more subscribers. It's not working.
No, it is actually working. It's just it priced in a lot. This company has been on Fuego, one of the biggest winners this year. So the earnings report was solid, but one of those priced for perfection. And if you look here, hasn't really fallen apart. Okay, we've talked about this. This was Sperling's play of the week down here at 228. Okay, we also talked about it in this area too 2 quarters ago. So all in all, gave you a nice move before earnings, and then since then came in a little bit and still above the 21 days, still above the 50. Holding support here. I would say the longer this holds above 240, the better it looks for this trend to continue. And it's been, it's been a really nice trend. It's still following it and going forward. Tactically though, on a short-term basis, you take a quick look here, and I think that you might be able to catch a cute little trade long if you're looking to do so above 247.66. For at least a move back to maybe retest 250 plus. But then you'll have to see how it deals with this broken area that could be, some resistance moving forward.
Okay, and Google, finally, last tech name we want to take a look at. It's been showing signs of weakness lately after it reported its earnings result a couple weeks ago. The story there is they're looking to, again, monetize mobile ads and things like that. Just the same issues we have with Facebook and LinkedIn will be listening for that too as well. So, but what are the levels you watching in Google here?
I think they tried to give it a pass on earnings.
Yeah.
Because earnings weren't great, but they weren't horrendous.
Right.
And people like, this is going to be the place to be. And I think every analyst is a $1,000 price target, so they were pounding the pavement to buy the dip. But anyway. Since the earnings, it's been just a little different. It's just been sideways. It's digesting, trickling lower. I don't see anything so bad in the chart yet, but I don't see any rush or reason to buy it as a trader. You look here, you will see that this is your your chart pattern. This was one of the last times looked really good for a breakout trade. And then from them, if you look here, you could even draw this line. It's coming into an area that's pretty important to hold. This was your earnings, okay? So you could have this as a point of reference, and this low here was 875. And then really major support is here. I don't think macro investors will have any problem with this thing unless it were to break below 854, and then all of a sudden maybe this upper area changes. But overall, it's just lethargic and out of play, and keep an eye on it though, because it wakes up at any time. For this, for here, I would say short term. If it gets to 875, see how it reacts there. If it doesn't hold there, then you have the 50-day. But overall, taking it in stride. And again, it's a summer, and it's a very. The stock is highly cash intensive to trade. So
Yeah.
you know, if no one's trading and it's going to float around, you
Yeah.
know, that's what happens with this type of stock when, you know, there's no catalyst around it for now.
All right, let's do some very quick hits.
Very
we'll,
quick.
We'll start with Tesla. I'll let you just go.
All right, Tesla, you know, take a quick look at this chart. I love Elon Musk. This has been a great trading vehicle, you know, on most time frames. It's been hovering above the 21-day right near highs. Great two-way action right here. You know, let's see if it could stay above that earnings, you know, that it got upgraded Friday. The longer it stays above here, you know, which is 126, maybe you get some continuation before earnings, but ultimately the next major move is going to happen on earnings, and make sure you have this pivot written down, which is 133.26. But ultimately, I love the name here, and I love the way it trades, and it's, you know, something that's been providing opportunity for most time frames. It all depends on how you want to approach it.
And then Starbucks had a huge pop on Friday on earnings as well. So.
Yeah, and this one, you know, we talk about, well, look at this chart here, you have to give it some time now. Either you were in it for earnings or not. And now you have a big gap here, so trade it versus 71.85. The longer it stays above this gap, maybe it digests and gives you another entry. But overall, macro investors rewarded. Congratulations.
All right, we're going to have to end it there. We're just out of time. Those are the stocks that we're watching, the sectors we're watching, the levels in the S&P that Scott and the team has his eyes on. Be sure to check in at the end of the day for Off the Charts.